Good morning. Welcome to Rising. We have an excellent show planned for you all today on this Tuesday morning. Briahna Joy Gray is back in the chair. Nice to see you, Briahna.
It's always a pleasure, Robby.
All right. What is our big story of the day?
Well, Robby, first, new data from the Consumer Price Index is out this morning. Inflation grew 0.4% last month and is up 6% from February 2022, in line with expectations. This marks the 8th month of decline after June 2022's record-breaking 9.1% peak. Americans are still feeling the squeeze across essentials. High food and energy costs continue to be primary drivers of inflation. These numbers come just after mass sell-offs wiped some $450 million from the global financial markets as investors reel from the crash of Silicon Valley Bank. Regional banks across the country are also feeling the SVB sting, according to MarketWatch. Spooked depositors are withdrawing funds from their smaller institutions in order to invest them in larger banks.
New details are emerging about what led up to Silicon Valley Bank's demise. The Lever reports that in the years leading up to the crash, SVB's lobbying group fought a proposal requiring financial institutions to increase payments into the deposit insurance fund that protects depositors from bank failures. New reporting from the Wall Street Journal reveals SVB executives ignored employees' pleas for stronger risk management after Congress reduced regulatory burden for small and mid-sized banks back in 2018.
Yeah,
so here we are.
This does seem like a recurring theme that every time some kind of crisis like this happens, or even crises that are somewhat different, like the East Palestine disaster, suddenly there's all of this reporting on the deregulation that precipitated this, the lack of risk assessors that were in key positions leading up to these kinds of crises, and a lot of people who were basically sitting there saying, I told you so, I could have anticipated this was going to happen, but you didn't listen to me. And in this case, and the East Palestine, there's this interesting feature where folks that are politically often disaligned toward the kind of regulations that could be helpful in this instance are very pro-reform, which begs the question, is it only after disasters emerge in a way that is kind of politically disadvantageous to you and your group, East Palestine, because it's Trump country, this bank because it's one that is frequented, used disproportionately by Silicon Valley business owners, a lot of people who are in the crypto craze and those kinds of things, that now suddenly you're into regulations only when things fail?
I take that point. I view this slightly differently, I guess. I think we've incentivized tremendous risk-taking in the banking and financial sector by perpetually bailing out failing financial institutions. You know, from my standpoint, it should be okay for an institution to take a risk, but then you have to suffer the consequences if things go badly. Now, we are letting SVB fail in that its shareholders are getting wiped out, its management, et cetera. There is this, it is a bailout of the depositors who were not insured by the FDIC. FDIC insures up to $250,000, but it sounds like something like 90% of the deposits in that bank were outside the cap where FDIC kicks in automatically. And they're getting bailed out. And look, you know, for all you can construct arguments for why this isn't exactly the taxpayers having to do it. It's coming out of FDIC. I mean, it's still other people's money for other circumstances.
It's a fund paid into by the banks, which has led some people to argue, well, where's the banks getting that money? And they make so much money on fees for particularly low-income depositors who, get overdraw fees and things like that, which have been predatory for a very long time.
The baseline truth is that when the FDIC, the government, whoever it is, they swoop in and rescue people who took a risk, who took a calculated risk, had a bad night at the casino, and then we come in and help them, you set yourself up you incentivize this very thing to happen again and again and again. Like you can invest your money in, you can deposit your money in less risky accounts. You can purchase more insurance through a variety of means. You can diversify your portfolio. There's all sorts of things you can do. They sought out this bank for specific reasons because it has a connection to the venture capitalist kind of cultural class.
Sure.
It provides, I'm understanding, when we had Matt Stoller on yesterday, and he was able to explain this in greater detail, and everybody should check that out in case they have more questions. He was able to explain some of the services this bank provides specifically for that sector. And again, that's fine. I don't think that should be crushed or regulated out of existence. But look, if you're going to engage in risk, you get to reap the profits of risk. But and these people they all want the benefit of risk when it works out.
Yes.
They're not saying those profits should be socialized. They're saying their losses should be socialized.
And I really take that point. I guess for me the question is really, is it really the case that the average depositor in this bank is a sophisticated investor in the way that we typically consider financial transactions. So someone making risky investments feels somewhat different to me than someone who says, I have this money, I need to put it somewhere that's not my mattress, I'm sticking it in this bank. Because that seems to me the kind of routine decision that isn't necessarily based on which bank it is. You just go to the first one that's close to you. And do we want to disincentivize people from using smaller local banks? Do we want to live in a world where we only have basically 4 or 5 large banks that truly are too big to fail and therefore are going to have exactly the perverse incentive structure that you described? And in this case, if, as you say, as you've rightly pointed to, the bank itself has failed, it's not going to persist, is that sufficient incentive to prevent the moral hazard of the bank who is making the decisions that are risky, continuing to make those kinds of risky bets?
We can only beat risk out of institutions in the long term if there is some consequence for getting it wrong, for screwing up, for making a bad bet. If it's all upside when you win, and then there's no downside when you lose, that's how we get this kind of calamitous.
Bank, but what about for the depositor? But that's the only thing that I'm still trying to
depositors should seek out. There should be a market mechanism for people seeking out safer places to deposit their bank, more fully insured
But
systems.
See, that's what this means. Like, does that mean, if you say that to people, then is that going to incentivize the kind of behavior that some people have reported is already happening, where people are taking their money out of smaller banks and moving them all into Bank of America and JP Morgan Chase? And is that going to create even a bigger moral hazard? Now, look, I think that part of the issue is the regulatory changes that were made are the bigger piece of the problem and perhaps should be a bigger piece of the solution. So, this particular bank is going down. I think that's a good outcome. But should we also be talking more about the fact that there should be higher limits on what value amount of your deposit is actually insured by the FDIC? There were lobbyists fighting tooth and nail against raising that cap. Should there be a higher tax on the banks paid into the fund that's supposed to insure these deposits? They fought tooth and nail against having to increase those kind of monetary amounts. I think those kind of reforms are less likely to create the outcome where people are disincentivized from actually using smaller banks. And it's not clear to me if this bank really was attracting sophisticated depositors who should have known better and therefore should take on the risk of having lost their deposits, or whether this was a situation where it just happens to be a small bank in a locality where there are a lot of venture capitalists because it's San Francisco. And as a consequence, they might be more sophisticated, generally speaking, but they didn't use
it sounds to me like these are more sophisticated depositors than the average, because it's not just, this happens to be the bank down the street. This is the bank down the street that specifically caters to a class of highly financially literate people seeking venture capital services. And I should say, you said a minute ago, a good thing the bank is done or is failing. Like, I obviously don't relish people losing their money. And okay, the depositors are being made whole.
Perspective.
Right. But like the same way, and I feel bad for people who are stuck with crushing student loan debt, and I'm sympathetic to them. I regret the structural things in our society that made them go down that route, and I would seek to change them. But just as I am absolutely against bailing them out, I similarly would not bail out these depositors, and I don't see how it isn't a really striking hypocrisy to be so against one and then totally in support of the other, which I'm seeing some people, especially in the tech space, who I knew to be very against doing the student loan bailout, saying, you're going to let the banking system spiral out of control? You have to do this. How could you want people to suffer? And using that same very emotionally manipulative language.
I think that's right. Larry Summers, chief among them. So I agree, and I think that's part of why I'm having this hesitation. Just like with student debt, I think that's a very good example. I would rather there be more attention to these structural efforts and actually help people out. The crushing, frustrating thing about this is that it seems very obvious to certain folks in the tech world, David Sachs, whomever, that these people are meritorious and should be bailed out. Whereas student debtors who did not choose to graduate into a time period when maybe they had an 8% interest rate as compared to someone else who had a 2, 3, 4% interest rate are being told, well, that's just the bargain. Well, what about all the people who worked at this bank who are like, oh no, I purchased these long-term bonds and interest rates run up and that's why we weren't able to cover our deposits. Okay, well, how are those situations different? And why do we live in a society where there's so quickly the government will step in to bail out one class of people but not another?
Yeah, that's a Good point. That's why you got to be. That's why I'm skeptical of the bailouts all the way around. A little bit later, actually, we're going to talk to someone, Vivek Ramaswamy, we've interviewed on the show before, is seeking the Republican presidential nomination and has really been sounding the alarm on the moral hazard of this bailout. He's writing about it on the Wall Street Journal and kind of clashing with other people in the tech sector who have been more pro-bailout. We'll hear from him coming up soon, later in the show. And right up for you next is My Radar. Stick around for that.